going on, guys? Chris here. I just saw this video from Larry Williams today, and I don't know, this is the first kind of report that I've kind of had some disagreement about, and I don't know, he's just oddly bullish, and it doesn't make sense to me. Like even with his own kind of cycle forecast indicators, I found like conflicting evidence as well. I don't know if it's just kind of what he wants to see, but he believes so much that it's so hard to have a bear market, or it's so rare that I don't know. He's a statistics guy, so I'm guessing he's leaning bullish, and based upon the statistics, like it's more likely that it would be bullish than it would be bearish, and in some way that makes sense, but not to the point where you just dismiss everything. And he was talking about unemployment. Let's see if we can find that. Are we in a recession? And then cycle charts talk about the money flow index, midterm year election bias. Uh, and then let's see if we can find one on employment. See, I remember seeing one. So that's about inflation. Are we in a recession? I think this is it for unemployment. Yeah, unemployment claims. Here.
Big question, are we in a recession? There are so many indicators to measure a recession. You can look at GDP, you can look at the yield curve. I look at that a lot, the spreads, unemployment rates. You can look at a couple of really interesting indicators. One is a debt on charge cards, how many people are paying off their debt on time. But the bottom line of all these recession indicators, the one that I think I found to be the most successful actually comes from unemployment, the continued claims. I explain this chart to you. These gray lines you see here are all times we've had recession. And notice that in the 2008 recession, the line picked up. The 2000 recession, unemployment claims picked up. They picked up in 1990. They had been high, picked up again in 1980. They picked up again in 1975. In 1970, picked up. Clearly, there is no one perfect be-all, end-all recession indicator. Some work sometimes, but the one that I think has been consistently the most successful has in fact been unemployment. So if we look at unemployment as the best indicator, we need to blow this up a little bit so we can see the current trend, what's been happening here, and here it is. Obviously, during the pandemic, unemployment went way up, but it's come down. Look where we are now. We have not done this. We haven't turned up in the indicator. So you tell me, are we in a recession? Or are we not in a recession?
So I mean, he doesn't see that uptick, and I mean, let me take a look too. Like, it's such a lagging data that it's just hard to tell like right away, and this might be the first uptick. You know, you just no. So yeah, Larry he's bullish. He doesn't see an uptick, so because he doesn't see an uptick in unemployment claims, he doesn't think there's a recession. And then this guy EBP Research, he does the same thing. He's looking at unemployment, layoffs, and this is kind of what he has to say.
Starting to pile up across the US economy. In just the last few months, we have seen major layoff announcements from companies like Microsoft, Meta, Stripe, PayPal, Tesla, and more. Real estate company Redfin announced that they were shutting down their home flipping business and cutting 13% of their workforce amid weakness in the housing market. trucking giant C.H. Robinson recently laid off 650 employees after reporting weak third quarter earnings results. And the CEO of C.H. Robinson said that he did not forecast truckload demand declining as rapidly as it did. So, why are all of these layoffs starting to pile up all of a sudden? Just a few months ago, the major economic stories were about worker shortages, specifically truckers. And now we are seeing major companies announce sizable layoffs across all industries, from technology to housing to transportation. Almost 3 months ago, I made a video on the jobs market that predicted that the labor market was going to weaken massively in the coming 3 to 6 months based on my leading indicator of employment. In this video, I'm going to show you why layoffs are starting now and why they're likely going to get worse. And at the end of this video, I will reveal what my leading indicator of employment looks like today compared to the last video in September. To understand why layoffs are starting now, we have to understand the predictable sequence of the economy. Employment is what we call a lagging economic indicator, which means that it moves very late in the economic cycle. In fact, there are many instances where job losses didn't begin until after the economy was already in recession. In both the 1974 and 1980 recession, the economy was adding jobs for up to 8 months into the recession. So to get an idea of where employment is going or where the lagging indicators of the economy are going, we need to focus our attention on what are called leading economic indicators. Leading economic indicators, as the name suggests, are things that happen way before the economy falls into recession, not months after the recession already started like employment. When the Federal Reserve makes a big shift in monetary policy, that is the very first signal that things in the economy will change about a year or so later. It is often said that monetary policy has long and variable lags. So late in 2021, the Federal Reserve started to announce a big change was coming. The Fed was going to move from very easy monetary policy, including low interest rates and quantitative easing, or QE, to tight monetary policy, including much higher interest rates. Whenever the Federal Reserve raises interest rates or tightens monetary policy, the sectors of the economy that are most sensitive to interest rates feel this change first. Right away, in early 2022, we saw the housing market start to slow down very rapidly. So first, the Federal Reserve raised interest rates and tightened monetary policy, then the housing market started to slow down. So what happens next? If the housing market slows down, that usually means that the consumption of things associated with home buying will go down as well. What do I mean by that? Whenever you buy a house, usually you need home appliances, furniture, and maybe some basic construction tools. Every month, the Census Bureau releases a report on retail sales activity, and we can actually break out the amount of retail spending that is going towards home appliances, furniture, construction materials, and even motor vehicle parts. When you adjust these items for inflation to get a sense of the volume of goods, you can see that the consumption of these housing-related items turns down well in advance of recessions. So how does it look today? Well, after COVID and the trillions of dollars of stimulus money, there was a boom in housing
like
and the
Target,
consumption of these housing-related
We
goods.
got
Housing
shares
consumption
plunged
has
15%
turned
after
down,
retailer
which is
reports
another
profit
warning
decline.
sign in the sequence of events that we are currently tracking.
So like Target was saying 15% plunge after, this is 1 hour ago, after retailer reports profit decline, warns of soft holiday quarter. Like, it's, I don't know, it you know, I love Larry Williams, but I don't know if he knows that unemployment claims are a lagging indicator. Like, it takes time for the unemployment claims to show up. And that's why Eric from EBP Research saying that we need to rely on the leading, and then the leading will, in logic sequence, lead to the lagging. And you know, with Target and their announcement about a soft holiday quarter, and you know, we got the bullwhip effect. We got lots of inventory versus production. I mean, we can see the chart here. Inventory versus production. Let's open up the big one. Go to inventory versus production. Right here. This is manufacturing production minus inventory, and there's just a lot of inventory and not a lot of production. So this has been this way for a while now, since like January. So this lagging data is just not coming through, and I don't know when the rate hikes really started, but yeah. So Eric mentioned about the rate hikes, and then that affected real estate sales because of mortgages were affected by the rates, and then what comes with homes is buying on consumer furnishings like furniture, anything that you put in a home, anything that would deal with construction and materials. And he's basically saying when they hit rates, they hit mortgages, they hit home sales, they hit all these retail, that it made a slowdown happen. And on top of that, if we take into account what happened in COVID with the stores kind of panicking with China and just the locking up in the ports, you would hear in the news just overflow of cargo ships, and they're just not able to unload. So the retail stores over ordered, and then now the demand is squashed, and then you can see the demand squash by XLY versus XLP, and the evidence of that is just how far down we are on the demand versus discretionary versus consumer staples. So I'm building the case that Larry Williams and his favorite indicator for a recession, and what he doesn't see is that it's lagging, and that we are probably closer to recession than you think, and that's shown by the demand destruction. It's shown by the drop in home sales, and that drop in home sales affected consumer goods and furnishings, which affected truck loads and trucking companies having to lay off workers, and just not enough. There's too much supply, and those layoffs trickling to everything else. So let's go ahead and finish this.
Tracking. So first the Fed said that they were going to tighten monetary policy, then they started to raise interest rates, and then the housing sector started to cool down. And now we are seeing the consumption of housing-related goods start to decline. So what's next? So if the slowdown in the housing market spreads into the bulky, durable goods like home appliances, that puts downward pressure on the transportation industry, or the industries that move these manufactured goods around the world. This is why the comments on the downturn in the trucking market from the CEO of C.H. Robinson are very important in terms of the sequence of economic events that we are tracking. So after a very sharp and sustained slowdown in the housing market, followed by weakness in retail sales of housing-related goods, and then confirmation of that downturn by trucking companies, you have a very solid and reliable sequence of events that spells trouble for the broader economy and the more lagging indicators like employment. These are all of the leading indicators, and when the sequence evolves in a very predictable way like I just outlined, it is confirmation that there is a cyclical process underway. So just by studying that sequence, it is not a surprise that now, after all of these events transpired throughout late 2021 and 2022, that we are starting to get announcements of major layoffs in late 2022 and likely into 2023. Again, first the Fed tightens monetary policy, then interest rates go up, then the housing market starts to slow down, and the consumption of housing-related goods turns down. Since the volume of goods moving throughout the economy starts to decline, there is less demand for trucking and all forms of transportation. And then layoffs begin, and this is where we sit at the end of 2022. In the last video I did on the labor market, I showed my leading indicator of employment, which is composed of 5 individual indicators like the amount of weekly hours worked and the amount of overtime hours worked. The leading index of employment had fallen to a growth rate of just 0.4%, a massive decline from earlier in 2021. The decline in the growth rate of this index, coupled with the sequence of events I just outlined, made a very strong and convincing case for a worsening labor market around the end of the year. A few months later, about to move into 2023, and now we are seeing major layoff announcements from companies from all sectors of the economy. Today, the leading index of employment has declined even further and has actually slipped into negative territory. Not only has the leading index of employment declined further and is now outright contracting, but the sequence of events is actually still getting worse. The Federal Reserve is still raising interest rates, the housing market downturn is still ongoing, and it is actually in much worse shape than it was a few months ago. The decline in housing-related goods is also still under pressure. So layoff announcements have started to roll in, but based on the sequence of economic events from the more leading components of the economy and the leading index of employment itself, it looks like this softening of the labor market is actually just getting started. If you found this video informative or helpful,
All right, yeah, we did. We hit the thumbs up button. I think it's his name's I forgot his name. I think it's like Eric. But dude, this guy's awesome. Awesome videos, great research, logical,
Order filled.
well thought out. So we're gonna just continue on just what we see here. Maybe we could see something. I don't know. It's probably too early. I don't know. Like, I would say it's too early. But in terms of like the real estate and the mortgage rates and all that, new home sales, existing and new home sales, yeah, it looks pretty bad. Let's see. Yeah, I mean, it looks pretty bad. Looks bad there. Existing home sales. And then the rates, and then we're still expecting the rates to go up higher. If we go to the expectations, so one would be the forward yield, around 4.85, and where are we right now? This is the Fed funds. We're at 3.08, so we got roughly negative spread. We have 1.78 points of hiking to go, according to the Fed funds. And then if we were to do it against the 10-year, it would be 1.28 points of hiking to go. And then if we were to do it against the year dollar futures, that would, so we're at 3.08. We go to the macro, and then we would check out section 5.3. So 3.08, 5.3, no, 5.18,
Stop filled.
5.18 minus 3.08. So roughly 2 points left to go, 2.1 points on the rate hikes. So, hearing just kind of both sides of the story and just a more well thought out side from just kind of what's going on in the economy. There's a lot we don't see, and there's a reason why these parties in the market are hedging for rate hikes and the bonds inverting. They're paying premium for hedging because they see proprietary data that we don't see, real-time data, and that real-time data might be the things related to those leading indicators of the rate hikes and just the decrease in real estate, existing home sales, new home sales, and decrease in consumer spending. I read aloud the softening of the holiday quarter of sales from Target, Amazon having a softening of sales and hitting the consumer market, and the trucking companies laying off workers because they were expecting a whole lot of demand to come through because the stores had all these orders. They were expecting all this demand, and this is the bullwhip effect, which is they expected all this demand, but then the demand got squashed. So then now, there's people losing on all ends, whether it's the companies laying off workers and just being in the red, or it's families not able to consume because they're in the red, or they have layoffs in the family, and then it eventually all concludes at possibly recession. Like, obviously, I can't say for certain right now, but unemployment claims is this Thursday, and it's a really big day. And you've heard it from me, just kind of where I stand. I mean, I really built up a bias on what I think is going to happen. And it's just Larry Williams, he's just bullish by default because of the statistics. But the thing is, like, when you take a look at the fundamental data, and then also incorporate the rate hikes that we have left to go, whether it's the Eurodollar futures curve, the 2-year, or the what's it called, forward yield, they're all saying we still have more rate hikes to go. And then Larry Williams also talks about inflation, but for some reason, I have his indicator for Williams cycle forecast, and I put it on the commodity side, and I'm able to see a second leg happen in 2023. But the thing is, he didn't acknowledge that he had a fast and slow of inflation, and he saw that the big cycle was coming down, and then he had some fast cycles that were kind of whipping in there. And I don't know, he dismissed the fast cycle, and he focused on the long cycle of inflation coming down, and that we're in the decline. I think that's correct, but after 2023, I think after July 2023, that would be correct, because it makes sense with this Eurodollar futures curve. The Eurodollar futures curve is saying, hey, there's some bad stuff happening in 2024. 2024, 2025, we're bottoming, and it's going to cause the Fed to stop hiking and maybe start QE. That's what it's saying, that there's a bad event. The banks or offshore dollars in those foreign banks and offshore from the United States, they're paying premium for hedging for something bad that's coming. And that's when it makes sense, when the inflation comes down, is when everything gets really bad. The thing that will kill inflation is just a really big recession. And that's kind of just, I think, what has to happen for the economy to really break. And I do think it's going to be persistent on a second leg. But I don't know. I think Larry Williams, I don't know, he's really bullish biased. He's and that's his default, and that's no problem for him. But he doesn't have the information about the Eurodollar futures, and I'm just kind of tailoring just kind of what he sees into kind of the fundamental data with Eurodollar futures, real yields. I think that's what this is. Forward yield, and the Fed funds subtracted from the forward yield, to see that there's still more left, even from the 2-year. If we were to do the same thing, there's still more of a spread that's left. I think there's the let's move this back. Let's see, this is the forward yield, this is the 2-year, and this is just regular Fed funds, and this is the forward yield. Yeah, so I don't know. It's just strange to me. And then, I think that's it. The whole concept was to talk about Larry Williams and just kind of his presentation that just came out today about unemployment and then he also had some cycle work on inflation, and I don't know. I just think he's flat out wrong, just straight up because of the bullwhip effect. The bullwhip effect is causing this chaos, and the chaos is because of the over ordering and the lack of demand, and then that now it's going to cause all these layoffs and a really big crush of demand, and it's also going to crush supply coming into the next year because the stores, they have over ordered, and then those orders are going to get eaten up. If anything, like, it's going to relate more to the commodity side of the bullwhip effect. And the commodity side of the bullwhip effect is that maybe people were getting high demand, and then maybe there was like anything related to I don't know, shortages and from the famine. And I don't know, like, to be honest, but we were in backwardation on a lot of commodities, and now they're just coming down because of the rate hikes. But we're talking about bullwhip effect and just it affecting supply or demand, and then that in turn affecting supply for the next year, and possibility of a shortage being put in place, which would kick up a second leg of inflation. Hopefully that came out logically correct, because of I'm trying to explain the bullwhip effect and how it affects everything. First, there's an over ordering, then the business suffer, and then they lay off people, and then there's demand destruction, and then less people buy from the suppliers, and then maybe over time their supply gets taken up, but it takes a long time, and then they decide, you know what, if this demand is going to be so slow, let's not order a whole lot. And then all of a sudden, like, there's this big demand for supplies, and there is no supplies, and then that creates a disturbance in the supply chain, and that's that bullwhip effect to where we could get a second leg of inflation because the supply chain's not ready for it because of the bullwhip effect. It's just too many weird choppy noise that's happening. So that's on like the macro level of the economic side, and fundamentally. So hopefully you got something out of this video. I did a comparison of two people and their views, and then also just kind of filling in what I see based on the charts and just everything else. But I'm siding with Eric on this one from EBP Research, that there's more to see.